Module 10. Realized return. Realized return is the actual rate of return an investor has earned on an investment over a certain period, based on the actual cash flows received from the investment. It is the difference between the total amount received from the investment, including any dividends or interest earned, and the total amount invested in the investment, divided by the amount invested. For example, if an investor purchased shares of a stock for $100 and received $5 in dividends, then sold the shares for $120, the total amount received would be $125. The realized return would be calculated as follows. Realized return equals total amount received minus total amount invested, divided by total amount invested. In this case, the realized return equals $125 minus $100, divided by $100. This equals 0.25, or 25%. The investor earned a realized return of 25%. Realized return is an essential measure of an investment's performance because it considers the actual cash flows received from the investment. It differs from the expected return, which is the anticipated rate of return that an investor expects to earn from an investment based on factors such as historical returns, market trends, and economic forecasts. Realized return can be used to evaluate the performance of an investment over a specific period and to compare the performance of different investments. It can also help investors to make informed decisions about buying or selling investments in the future based on their actual returns. Weight of stock in a portfolio. The weight of a stock in a portfolio represents the percentage of the portfolio's total value invested in that particular stock. It measures the stock's importance to the portfolio's overall performance. To calculate the weight of a stock in a portfolio, the stock's market value is divided by the portfolio's total market value. For example, if an investor holds a portfolio of $100,000 and $10,000 of that portfolio is invested in a particular stock, then the weight of that stock in the portfolio would be 10%, i.e., $10,000 divided by $100,000. The weight of a stock in a portfolio can significantly impact the portfolio's performance. A stock with a high weight can significantly affect the portfolio's overall performance if it experiences significant gains or losses. On the other hand, a low-weight stock may have little impact on the portfolio's overall performance, even if it experiences significant fluctuations in price. Investors use the weight of a stock in a portfolio to determine the level of diversification in their portfolio. Diversification is the practice of investing in a variety of assets in order to spread risk and reduce the impact of individual stock fluctuations on the portfolio. By monitoring the weight of individual stocks in a portfolio, investors can ensure they are moderately concentrated in a single stock or industry and maintain a diversified portfolio. Dividend growth rate. The dividend growth rate is when a company's dividend payments to its shareholders increase. This rate is often expressed as a percentage and is calculated by comparing the dividend payment in one period to the dividend payment in the previous period. For example, if a company paid a dividend of $1 per share in the previous year and paid a dividend of $1.20 per share in the current year, the dividend growth rate would be 20%. i.e., $1.20 minus $1, which is 20 cents, divided by the $1. This is 0.2, or 20%. The dividend growth rate is essential for investors interested in income-generating investments, such as dividend-paying stocks. A company with a consistently high dividend growth rate indicates that it is financially stable and has a strong track record of increasing its earnings and returning profits to shareholders. A high dividend growth rate indicates that the company is likely to continue increasing its dividends, which can provide investors with a steady income stream. In addition, a high dividend growth rate can increase the value of the stock over time, as investors are willing to pay more for stocks that offer a reliable and increasing stream of income. Investors can use the dividend growth rate to compare different stocks and make investment decisions based on the potential for future dividend payments. However, it is essential to note that past performance does not necessarily indicate future results, and a high dividend growth rate does not guarantee that a company will continue to perform well. In summary, the dividend growth rate is when a company's dividend payments to its shareholders increase over time. A high dividend growth rate indicates that the company is financially stable and has a strong track record of increasing its earnings and returning profits to shareholders, which can provide a steady stream of income and increase the value of the stock over time. Effective after-tax interest rate expense. The effective after-tax interest rate expense is the interest rate that a borrower pays on loan after considering any tax deductions for which the borrower may be eligible. When a borrower pays interest on a loan, the interest expense may be tax-deductible, reducing the actual borrowing cost. The effective after-tax interest rate expense is calculated by subtracting the tax savings from the interest rate. For example, if a borrower has a loan with an interest rate of 6% and is in a tax bracket where the tax rate is 25%, the borrower can deduct 25% of the interest expense from their taxable income. This reduces the effective interest rate to 4.5%, i.e., 6% minus 25% of 6%, or 1.5%, for a total of 4.5%. The effective after-tax interest rate expense is essential for borrowers because it provides a more accurate picture of the actual cost of borrowing. By considering the tax deductions, borrowers can compare different loan options and choose the one that offers the lowest effective after-tax interest rate expense. This can help borrowers save money on interest payments over the life of the loan. For lenders, the effective after-tax interest rate expense can also be vital because it affects the attractiveness of their loans to potential borrowers. Lenders may offer lower interest rates to borrowers eligible for tax deductions on their interest expenses, as this reduces the effective cost of borrowing for the borrower. In summary, the effective after-tax interest rate expense is the interest rate that a borrower pays on a loan after considering any tax deductions for which the borrower may be eligible. It is an essential consideration for both borrowers and lenders as it provides a more accurate picture of the actual cost of borrowing and affects the attractiveness of loan options for potential borrowers.